Trade and Justice Podcast 521. We're going to start a multiple part series on the dollar. This is a subject that fascinates me right now. I'm starting to see more and more headlines into it. I'll talk about that here in a second. And fortunately, I have a biological brother who happens to be an expert on the subject. And when I say an expert, like, you know, just knows more than any human being should know about this subject. So I have a resident expert. I can pick his brain. I got a lot of questions. We're going to go over these fake markets, Matt, a little bit too.
We will. Bull.
We're going to break it all down, but how you doing, Matt? We're recording this on a Sunday. This is the first time I've ever done a Sunday podcast with you.
Loving it, by the way. Coming to you from a Sunday afternoon, no doubt about that, but excited to be here for another edition of the podcast. And, you know, my good friend Robbie Law told me one time, he's like, you know, Matt, mastery is not, it doesn't mean you're smarter than somebody. It just means you've sat in that chair and you put the time in. And if it comes to the amount of time it takes to master a subject matter, I don't know how many hours I got my butt in this chair, but I've done a lot of research on the history of the dollar, what it means for our society, what it means for us moving forward. I think it's, I've oftentimes said that the dollar is our number one investment, which means it's also our number one risk. And we just need to have an understanding of what it means to invest in the dollar, because what does the environment look like for you if there is no dollar and you have everything in dollars? Now, I don't think that's what we're looking at, but I truly do believe it's vitally important for everybody to understand the history of our currency, because if you can understand the history of our currency, you can paint the picture of the future, because we've been here before.
Yeah, I know. Listen, knowledge, and I believe this, knowledge reduces volatility in your own life. Right. Like,
Very
you
true.
know, like just knowledge reduces volatility.
But where does fear live? Fear lives in unknown.
You know, and so like knowledge it's just so important. So we're going to tap into some knowledge probably for a few podcasts as I line up.
I would say at least a 2-part series.
At
here.
least let's call it. This is going to be like .com, right?
It's
like where I'm like, yeah, we want to do this one,
series.
and it's just such a huge subject.
Still, well, I mean, the reality
we're living in .com parallels, by the way.
They are out there. There's no doubt about that. They are out there. But I just say, and again, I know we're going to get into it here in just a moment, but if you want to really dial in the dollar, you got to talk about, okay, the historical argument. What is the historical argument for currency? What is the current state of currency? And what does the future hold for us from a currency perspective? And so 3-part series makes sense to me here, Chucky.
Yeah, no, and this is a story that plays out over time. Yeah, I'm very much looking forward to it. Genuinely got a lot of questions, certainly more than one podcast's worth. Mm-hmm. Plus, you know, the more time we talk about the dollar, the less I have to prepare for the podcast. So,
So you just got to ask me a question. Let me run. Is that what you're saying?
Well, yeah, I already have the questions on my mind.
Okay,
right?
Good.
You know, all right. So let's get to these fake markets. And I say that tongue in cheek because, you know, as a peruser of message boards, I promise you that's the phrase that bears are using right now, and bulls are saying scoreboard. Right.
And that was a fake whistle referee, and the winning team just points at the scoreboard. So the Bulls are just going to point at the scoreboard here, no doubt. They got momentum though, Chucky.
You know, and last week we talked about kind of the tactical bullish case. I mean, we talked about this a week ago, and you know, I've made no hiding of my bearish views over the last year. But you know, you've heard me on the halftime report. You heard me last week, and hear me here today, Matt, talk about I still have this tactical bullishness for a lot of reasons. First and foremost, bears suck. And when I say that,
it's tough to be a bear.
Man, I'm beginning to wonder if you can ever have a true leg down when bears are so short and there's so much negative positioning. And I'm like, have we just reached a point in modern markets where there's so much knowledge, right? Knowledge reduces volatility. Well, are just so many people aware of the known problems that they try to position, and that just creates a dynamic where like everyone's hedged.
Well, it's not that the Bears don't have arguments. They have arguments. There's no doubt about that. It's the fact that the Bears are running up against a institutional situation from the financial markets perspective. And so when you're looking at the bear argument, it's pretty easy to point out. We got a massive geopolitical situation happening between Russia, Ukraine, the ongoing issues with China kind of paint the storylines in and of themselves. Obviously, China had another trade agreement with Brazil just a few days ago to use non-US dollar transactions in international trade. Not the first, certainly not going to be the last trade agreement China signs in non-US dollar transactions. That's kind of been a trend for them for really kind of the last 13 years since 2009. But you've had a lot of hot and heavy geopolitical situations out there. And when we're all, kind of nervous about the geopolitical landscape, that's usually not a good sign economically. It's not a good sign from a market perspective. And so it certainly does bring up a lot of concern. And then when you're looking at the economic landscape, obviously with the banking crisis still, not certainly not in the rear view. It's still an ongoing situation, but we're through some of the worst parts of that short-term situation. Does it bleed into an intermediate to long-term problem? We'll talk about that if it does. But we're kind of through that shock and awe part of it. And now let's see where it goes from here. But the worst case scenarios didn't play out. When you look at the inflationary environment, we're still dealing with some of the worst inflation consumers and investors have had to deal with in the United States and quite frankly, from around the world in the last 40 years. And so when you're looking at that landscape and you got geopolitical nonsense, you got economic nonsense, you got inflationary nonsense, it will ultimately really impact people, especially when they're hearing these messages from politicians. It will impact the way they see the current environment. It will be a little bit hazy when they're looking at the current environment, and it certainly will spark fear out there. But when you think about that bear argument, and you start getting into the, oh my goodness, Chicken Little, the sky is going to fall type analysis, you fail to realize one really powerful tool that the bulls have that bears don't have. And that's the United States Central Bank. That's fiscal policy. That's the that's the plunge protection team. That's every difficult economic conversation that we can have. There's tools that they will utilize in these environments to stave off that volatility to a certain extent, to push down, to kick the can down the road to a certain extent, which we've done now for 40 consecutive years, kick every debt problem down the road, every inflationary problem down the road. Well, let's let some other politician have to deal with that. Well, let's let some other let's let some other central bank president have to deal with that. We're really good at kicking the can down the road here in America. And so when you're looking at that bear argument, the bears failed to realize that all the rules of this game called the financial world are built for the bulls. And in times of crisis, that's when these tools that the Fed has, that's where these tools that the fiscal government has to come out and fight off some of this short-term volatility. Because if it was a fair playing field, Mark, if it was a fair playing field, like we were lining up in the Super Bowl, and you were one team and I was another team, and let's call you the Bears and let's call me the Bulls, and it's a fair playing field, Bears have all the winning arguments. Bears got the best quarterback. Bears got the best wide receiver. They're faster, they're bigger, they're stronger. They got the momentum right now. Yeah, they have it. And so if you're looking at the landscape of the financial world in hey, this is supply and demand, this is a free market. We don't live in a free market. The asset value of or the price of an asset does not reflect just supply and demand. We live in a modified free market to where all the rules now, instead of those rules being equal and fair and balanced and equal for you, the bear, and for me, the bull, they're not. You get a holding flag, you get a holding penalty called on you every other play. I never get anything called on me. If you touch me down the 10 yards down the field, we're going to throw a flag on that as well. But I don't have anything. The refs are on my side. And so when you're looking at it from a perspective of fairness, yeah, you're right. It's going to be a difficult argument for the Bulls to make. But when you look at it with all the rules set for the Bulls, it becomes a little bit of a different conversation.
Yeah, no, and you have to understand this about modern markets. Man, I put up a chart for you to look at. It's money printer go burr, right? It's a bullish rallying cry. And when the Fed's balance sheet skyrockets, that has been traditionally very, very bullish. What's funny is like you get into numbers that almost seem surreal that you have to do some comparison by them. We had a spike in the Fed's balance sheet that basically equated the spike in the Fed's balance sheet after the financial crisis.
Yeah.
That's how big the increase of the Fed balance sheet was. And whether it was QE or not QE, whatever you want to call it, right? The effect is the same. What have you seen happen since the Fed's balance sheet skyrocketed? You've seen gold go up. You've seen Bitcoin go up. You've seen big cap techs just have a great time, right? This is the QE playbook, man. This is the QE playbook right now. And it's not a surprise that since that balance sheet went up, you've seen the price action. This has played a large role into my tactical bullishness over the last little bit. You can't have I don't know if markets can go down if the Fed's printing. Now, will the Fed continue to print and all of that? I don't know, but they sure did blink the last couple of weeks, didn't they, Matt? And it lets everyone know that if there's another crisis, Bear's saying, well, this is going to happen, and this is going to happen, and this is... Well, what's the Fed going to do during those too?
It's not that the Bears are wrong in that, because there are a lot of uncertainties out there. There's a lot of variables that can certainly play out to the negative side of the equation for the market. But at the end of the day, those variables, if you look at them in equal weighting, which you should, variables impact to the positive, variables impact to the negative. You have expectations. If an economic report comes out above the expectation, you have one price response. If it comes out underneath the expectation, you have another price response. It's not the variable is how the market's going to react to the news, right? And some of the most negative news out there, and the market responds bullish. And some of the worst, some of the most bullish news out there, market oftentimes will use that as a profit-taking session. Mark, this is not the first time it's, buy the rumor, sell the news type environment. We've been dealing with that for 100 years in the market. It's not the first time we've seen any of this play out. And so when you're looking at it from a generalized perspective of fairness, the Bears, they're always going to complain because they're complaining not at the price action. They're complaining at the fairness argument is what they're really doing. And the reality is it hasn't been fair since 1987. So it's not even, it's comical to me when we get into these arguments because this isn't even a discussion. From Ronald Reagan in 1987 with Alan Greenspan until today with President Biden, Janet Yellen and the cronies at the Fed, it's been the same game. It's been designed for the bulls, and I'm pretty sure it was that way even before 1987 as well. And so the Bears have pockets, Mark. That's what they have.
They have pockets
of volatility.
And that in 2022, one of the reasons I was so adamantly bearish is the Fed didn't have your back. The Fed consciously, and not even, Wijo Karkashi was shorting the market. Like he would come out with statements being like, I don't like that upward price movement. They weren't hiding.
CPI was going to go through the roof. Interest rates were going to go through the roof. They were obviously talking down the market. But yeah, Mark, there's this old adage in the market that the Fed hikes until something breaks, right? We've all heard that adage. And the Fed was very, very aggressive throughout all of 2022. They were pretty aggressive even coming into 2023. Remember, that first pause we talked about hypothetically starting was in the fourth quarter of 2022. Now, that conversation was well over a year ago at this point, but that's when that first expectation of the pause, they were still pushing that in all the way into March and now coming into April of 2023, because inflation's been really sticky. It's been very sticky in that 5 to 6 range. And so they were even hawkish just coming into the last couple of weeks. But when the Fed hikes and then something breaks, circa what happened with Silicon Valley, Signature Bank, Credit Suisse, just to name a few of the banks that were underwater over the course of the last 3 weeks, well, that changes the dynamic a little bit. There's now new variables in the equation. And what those new variables are the economic recession, because it's really, really hard to maintain your projections. And I'm speaking as the central bank for a second. If you're the central bank, it's really, really difficult to maintain your GDP projections. Let's say you're at 3% before a banking crisis. Well, you have to lower that coming out of the banking crisis, because you know what's going to happen with the confidence levels around consumers and investors over the next 3 to 6 months. That's going to have a lagging impact there. And as that has a lagging impact, well, institutions are going to be a little bit more leery about, bringing on new debt. The consumer probably going to tighten up the purse strings a little bit. They're going to be a little hesitant to bring on new debt. And then you take into account the banks. The banks are not going to be ambitious in loaning out loan origination over the next 3 to 6 months. And so you get this new variable, and it changes the dynamic, because if the Fed is focusing inflation, Mark, if now you're looking at a lower GDP threshold than what you were looking at before the banking crisis, and now you're taking into account that crisis of confidence that absolutely will occur throughout a certain percentage of the demographic throughout America due to the banking crisis, you also have to lower your GDP for that. And as you lower your GDP, that lowers the demand threshold. Well, what does that do? Well, that takes over the job of raising rates to combat inflation. And so all of a sudden now you're basically saying, well, the upcoming recession, that's going to take care of inflation in and of itself. We can wipe our hands with that to a certain extent if you're the Fed. And now we can be laser focused on the things we have to do to solve this latest crisis. And we all know what those tools are. Quantitative easing. We already know they're doing quantitative easing. I don't care what he says about quantitative tightening. You cannot expand the balance sheet of the United States Central Bank without calling it quantitative easing.
You just can't.
The expansion of the balance sheet is quantitative easing, regardless of what you're doing it for.
If not in name, it is in effect.
It's in practice, right? If not in name, in practice. And so you now know what the Fed will do in these moments. And yet, Mark, the only difference for a lot of newer traders today versus where you and I are on this subject matter is we've been through it before a few different times.
Mm-hmm.
We've seen the Fed.
I have been the individual who's like, how can stocks be going up with this and that? Like,
oh wait, that was me in 08.
And that was me in 2011. That was me, when you're starting. The plain and simple fact is, if you inject money into the system, listen, I'll grant you, Bears, we're going to have a recession. That's my base case. I don't think, it's just a matter of when. We're going to have things blow up in the future.
There'll be more things that break.
And I don't know if it's bearish, right? Those are the seeds of doubt, because we know the Fed's playbook. You got to think of this in an advanced game theory standpoint, is that if you know things are going to go wrong, and you know the response when things go wrong, well, what is the net result? The net result is not all assets, right? Your average random small cap penny stock is going to be on its own, but big cap tech, gold, Bitcoin, bond. Yeah, I mean, we know how this plays out in the major assets classes that we can predict. Now, the variable, Matt, is inflation, isn't it? I mean, that is the variable. Because what happens, that's the one scenario. What happens if inflation stays sticky as you have recessionary things? Now, I don't think that's going to happen.
Yeah, that one's a tough one. That's a tough bridge there, because it's real. Inflation was already on a path in terms of continually downgrading inflationary expectations. You went from mid-9s, 10%, 6, 7, 8 months ago. You're now down around 5 to 6%, depending if you're looking at CPI or the PCE report. PCE came in at 5%. We're around 6% in the CPI. You've had a good reduction from where we were at 6 months ago. I don't care who you are. You have to appreciate the reduction of inflation from where we were to where we are. That's not to say the job's done. That's not to say 5 or 6% inflation is okay. We shouldn't be settled for that. If we settle for 5 to 6% inflation, you might as well double the poverty rate in America right now. And so we can't settle for that. The job's only half done. We got to be vigilant on the job against inflation, and we got to pound that until it is in the dirt type thing. But how can you not, if you're going to look at the landscape and be like, all right, we're going to have a
Yeah,
national
if my
recession.
base case is recession and things
How
are
does that,
falling,
how do you not 2+2 this and say you also have a reduction in inflation out there? Like I hear politicians right now say a lot, oh, look at all these horrible, horrible, horrible situations. We have a massive recession coming at us. We're dealing with the biggest inflation. And I'm like, yeah, you're right. But yet if your analysis on the recession is accurate, that fixes the inflationary scale really quick. And so
it does.
It's like, it would be really difficult for me to see an environment where we go through a recession, you get demand catering, you get demand destruction, without also simultaneously see that inflationary scale coming down. That would be really, really, really difficult for me to see. And so I think it's one of those rock and hard places at this point. Well, pick your poison. Would you rather go through a recession, or would you rather go through elevated long-term inflation? And I'm going to tell you right now, you would rather go through a recession than long-term inflation.
Yeah, no, and so for me, and none of this is to suggest that stocks go to the moon here, because we're not in 2020 where the Fed was expanding their balance sheet month after month after month after month.
It's a pocket. It's a short-term pocket.
This is a short-term pocket. Doesn't mean stocks can't slide. But, you know, we mention this all the time, this phrase, there are two levels of analysis, how high can stocks climb and how far can they fall? And while, you know, there can be fluctuations here and there, I do think the upside is somewhat limited, although I do think we're going to break that 4,200 level, because you have to destroy the bears in the positioning. Bear markets are particularly tough on bears, ironically.
It's really weird. It's really weird.
It's, you know,
listen, some of my best bearish trades has actually been in bullish markets.
Yeah,
where you get an individual news story.
You get a select name that
is just, it's easy to look at because everything else is either neutral or bullish.
Or 2021, where the market was bullish, but you had certain areas, the high growth selling off. That was great.
That's what I'm saying. I mean, it's hard in like bear markets for the bears because everything in the market's going to go with one another, and there's a lot of tools to stop volatility for the central bank. And so it is a difficult environment. But when you're looking at the market and specifically answering that ultimate question of how high, how far can something go, you know, Mark, the current market momentum in the market is absolutely on the bullish side of the equation. You've seen a breakout occur this week. You've seen momentum increase on the back half of this week. And it certainly does look like the market wants to come in and test those 4,200 zones, you know, and that's kind of where that 41 to 4,200 zone was kind of that top level of the market, right? Where if you're looking at the market in some degree of intermediate neutrality, that upper end of resistance would be 4,200. And when you're looking at that 4,200 zone, it's right there on top of the price action right here. And if you're looking at the ability for the market to break through that level, it's got a better chance this time than it's had in quite some time. I'd still like to see it, but we're only 20 points away from it either. You know, I talked about this all week long in the halftime report when we were talking about the potential of the market getting up into 4,200. I was saying this is a really good pocket between that 4050, 4100 zone and 4,200. Yeah, it does feel like a magnet. It does feel like it wants to go up there and test that 4,200 zone. But Mark, if you can dance the dance and break out of 4,200 in the S&P, that's ultimately where the bulls want to push this, is above 4,200, because when you get above 4,200, there's nothing, you got to pivot at 43, but then above 43, you really kind of work into 45, 4,600, and it does open up quite a bit. Now, do we have the combination of you know, behavioral, fundamental, and technical analysis that would get you to have such a large oversized movement in the market? Probably not. It's the equation, because again, variables work both ways in the market, but you certainly have an edge to the bull here. There's no doubt about that. It does look like it wants to dance around that 42. Now, when you're looking at worst case scenario to the downside, you know, early, about 6 months ago, I'd say 35, 36 was my cap. I still think 36 is kind of 35, 36 is that number. whenever you would bring up the possibility of a 3,200 handle in the S&P, I would always say, maybe, I don't know, hypothetically it could get down there, but you got to get through 35, 36 first. And my eyes just can't do that. There's just such a foundation of support. But that's such a far away, Mark. I think if you're anchoring on support right now in the marketplace, you're anchoring against your moving support levels.
Yes, you are. I mean,
right. And explain that for a second, because you're the one who coined that adage.
And I'm going to be doing a hard 14 mastermind group this Wednesday on this specific topic. I'm going to just outline very briefly for you. When you get blow off days, like we've had the last few days, right? These big, huge, massive green candles, the last thing in the world, if you are other than a day trader or a hyper swing trader that are taking profit, you do not want another candle like that. No, because what you risk is the whole thing collapsing on itself until it goes clear back down, right? And so what you need, and you can go find this on a lot of different charts right now. If you go look at gold miners right now, it's a perfect example, is that those moving averages, which are a little far away to start the week, I wouldn't be surprised to see a pullback of the start of the week. Doesn't mean it's bearish. It's just how markets and price action work, right?
The series of events that would have to occur this week for me to go from the current bias in the market to a bearish ranking, I'm not sure they exist. I don't like. It would be really difficult to go from that this week.
And so what you see in these things is like and because you're a little overextended from the 9, that it can feel like, oh my gosh, the market's falling apart in those couple hours. It's just a normal. It's what happens.
Same energy.
You see the price, you see profit taking, you see a natural reversion to the mean. And these moving averages in these short-term uptrends, they are constantly acting as a reversion to the mean. Now, for bulls or for bears, when it's on the other side, those are rising every day. So the reversion to the mean is higher and higher and higher every single day. And so what you would really love to see, like me, interested in staples, like me in adding to big cap tech, is to come down to that rising 9, find its support, and then give you an intraday signal. This is classic momentum pullback analysis 101. It's going to happen. It's just a matter of when. You're not going to find something riding above the 9 indefinitely. Never happened in the history of markets ever.
Oil tried it that once about 40 days.
They can try it and it can be impressive, but
it doesn't last though.
Yeah, even if it's a quick intraday move down, then move up, you're coming down and testing that rising 9 consistently.
And I think that the greater point, if you want to see how that's done technically, join us on the halftime report on our Tackle Trading YouTube channel, which we break down the technical conditions. But when you're thinking about what Mark's talking about, the market currently has momentum to the top side. And so the market's quite elevated, especially after Friday's close. It was a really powerful close on Friday, punched up a little aggressively and got out in front of its skis just a little bit. What we're talking about in identifying where the market can go to the top side, that's pretty easy. Both Mark and I can just say 4,200 because that's the previous pivot multiple times at 4,200. But when you're looking at when the market starts a bullish trend, and I don't know how you can look at the current trend in the market and not say that's a bullish trend. And so when you're looking at the current bullish trend, it's not a matter of your horizontal support levels, your horizontal resistance levels. Those numbers are going to be what those numbers are. It's a matter of finding those moving support levels. And that's what moving averages do really, really, really good at, is they are that moving target, right? They give us that updated, constant moving target where that market can find support. And so with the market being a little bit overextended to start the week here this week, I do think one of the things we're looking at is I certainly do think 4,200 is going to get hit this week, Mark. Like I do think that's
if not this week, then certainly next week.
Yeah. Let me paint it
within days.
Within days, right? I certainly do. I think, and so you're at 4180 to start the week. You're very near that resistance zone to start the week. I do think it might be one of those scenarios where it's ongoing trades and it's really kind of getting ready for that next movement in the marketplace. And what is that next movement? To me, it's what we're just talking about here. A retracement back down into support. That would be a really, really good picture. And the market has to do that for the market to find some sustainable growth that lasts more than just a pocket of time, that lasts more than just 3 or 4 days in a row. It's got to have a series of higher highs, higher lows to it. So we got to have that retracement at some point. And so it does. So a retracement here in the market makes some sense to look at midweek. A high base against 4,200 would make a lot of sense as well.
And guess what? You could get both of them in the next week.
you could, but something on the momentum side of the pattern. But it's been really impressive to see the bulls shake off the current volatility in the marketplace. And obviously, it has. And the one point I want to make here before we move to a different conversation, Chucky, is it wasn't the movements we're seeing this past week were not an individual sector or two. It was broadly supported by most sectors in the marketplace. And whereas in the past, we've seen sector rotation models where one stock goes up, comes down, right? One sector goes up, the other sector comes down. You see these rotation models. And now what we're seeing actually is stability and then upward movement in price. And it really is broad in the marketplace for in the market. So it's been a little bit of additional bullish momentum without too many sectors showing a lot of bearishness this past week.
Yeah, no, listen, let's just talk a little bit about commodities. My final thought, if you get a pullback on Monday or Tuesday and you're still above the 9, bulls are still fully in control. They're still fully in control. I'm looking to buy that pullback, particularly in staples, big cap tech. Something I'm looking to buy no matter what, Bitcoin, gold, beautiful technical patterns. Man, when I did the commodity report this weekend, I'm like, you can talk macro themes, you can talk this, you can talk that. Next couple of weeks, it's all about technicals, right? Yeah. I mean, it is just the next couple of weeks, you have Bitcoin at a key technical level, forming a high base. You have gold at a key price level, forming a high base, right? I mean, it's, I don't know how you don't do some moderate add on either one, even if it is a cowardly naked put. But certainly other aggressive plays are certainly in line if you get clear breakout signals on both of these levels. Thoughts?
You know, my take on gold and over the next 3 weeks as we, talk about the history of the dollar, talk about the current situation with the dollar, and talk about the future of the dollar. And I promise you, I honestly, I hope everybody gets a lot of value and a lot of understanding over the next few weeks regarding this conversation we're going to have on the dollar. But if there's, and I'm not saying there isn't great information out there. I just know that my data and I have a pretty good understanding of this topic, Mark. I did a webinar. I posted in our Discord channel just a couple of days ago, but I did a webinar about 8 years ago on this very topic, and I'd done that webinar a lot. It was part of a currency class I used to teach, and in that currency class, I would talk about the dollar, the future of the history of the dollar, and thus the future of the dollar. And I gave some predictions out there, Mark. And those predictions kind of came true. And a lot of them were what people are talking about concerning today. I was talking about this 7, 8, 9, 10 years ago. And so we're going to have a really good conversation. But if there's one thing that you will probably get out of that conversation is this is where my fundamental belief in gold comes from. And so, yeah, to answer your question, absolutely, you're going to want to have some gold. I've been saying that over the course of the last, I've been saying it for 10 years, but specifically over the last couple of months, my statement has been, you're absolutely going to either want or need gold coming out of this environment. And so when we're talking about gold right now, there's a level that's got to be looked at, and that's the $2,000 price point.
G2K, baby.
G2K. It's been sitting right there over the course of the last couple of weeks. Gold was overextended coming into 2K. Now we're getting the consolidation and the pattern recognition that we really want to see on gold. Gold looks really good above 2K at this point. When you're looking at Bitcoin, a little bit of it'll run on the same type of gasoline right now as gold. Obviously, they are not correlated, but right now they are rocking together. And so same team Bitcoin, same team gold. High five, everybody.
Same team. We're on
Digital
the same
high
team.
five. We're on the same team.
I am more team Bitcoin.
You're team
than
Bitcoin,
gold,
I'm team gold.
but I participate in both
same team.
religions.
Same team. Same team, right? Bitcoin, I think you're looking at the same type of conversation here. It's fired off a little bit in the banking crisis. There's 1, 2, 3, 4 things that will emerge out of the banking crisis, but a healthy fear of storing fiat currency, paper currency within a digital banking system might be one of those. Crypto getting the beneficiary coming out of that. Bitcoin's been on fire. Now you're dancing 29K in Bitcoin. Same type of conversation. Maybe not the importance of it, because that would be like us talking about Bitcoin at 70K, not 29K. But you got a really good breakout channel at 29K. If you're looking at BITO, the ETF that tracks it, track 18. $18 on BITO looks rock solid as a resistance level. That's why we put it on our scouting report this week above 18, because if you get above 18, it opens up a little bit to about 20 on BITO. It
opens up Bitcoin to 300,000. Screw y'all.
Well, if that's going to occur, I like my gold position. But in terms of Bitcoin, and if Bitcoin does, listen, I'm not going to be on that freight train the same time frame the lovers of the crypto community will, but I'm not going to be cheering against them. Like, I'll be like, same team. You're right. And while you're talking about the volatility and what Bitcoin can do, I'm just going to be dancing around, gold at 2,500. I think we're all going to be good there.
We're all going to be happy.
But they both look fairly similar here. What I would say is Bitcoin looks like a trade above 29K, 18 on the ETF, whereas gold looks like an add to a portfolio above 2K. And so I think, one, you'd be looking at Bitcoin, at least for me, I'm looking at BITO in the short term, more in the swing trade type position. It's got a really good setup. On gold, I just think this is an add from a variety of different levels because of the potential of what could occur above 2K.
Yeah, I look forward to the FOMO rally to 1 million on Bitcoin one day. Oh, I hope I'm alive to see it. Yeah, listen, Matt, there's been 4 Bs that I've been centering my personal decisions around: bullion, i.e. gold, Bitcoin, not crypto, Bitcoin.
Just Bitcoin. The king and queen of Bitcoin, of crypto.
Big cap tech. I'm because big cap tech. Listen, we have a crisis. Google, Microsoft, flight to safety. If we have QE, they get
flight safety.
I can't see a scenario. Yeah, sure, you can sell off.
Economic recession. They have the moat.
They win everything. They win everything. And then bonds, which we'll talk about another day. I'm about to add a 5th B, black gold, to the list. Now, I've been tinkering around.
You're just trying to get creative with the Bs, aren't you?
Well, 4 Bs need a 5th B. Listen, Matt, today we're doing this on a Sunday. OPEC came out today.
Yeah, they did.
And they said we're cutting by 1 million barrels a day. I joke. How many years have I been making the same joke?
At least 5.
OPEC has your back. Ever since they screwed up in 2014, they learned some valuable lesson in the fracking war. We'll have to do a podcast on this at some point.
The petrol wars of 14 and 15 are fascinating.
They are. And OPEC.
Mark, that's an excellent point you just made, because they fundamentally changed the way Saudi Arabia saw oil. Before this, they would do anything to cut, to drive the value of oil down, right? They would do anything before like 2017, because it took a few years for them to learn.
They viewed it as a zero-sum game.
They felt like they could corner the market by kicking out all frackers, all those smaller companies, because they knew one thing up until this point. If they lower the value of oil, they corner market share. Jamie Dimon, JP Morgan, and what they try to do in the gold markets, they try to corner the market share, right? And then when you corner the market share, you come out of that with, hey, we don't care where the value of oil goes. But what happened in 14 to really kind of 2016 is oil went from 120, 130. It went all the way down to about $27 a barrel, when Saudi Arabia was specifically trying to lower the value of oil to really harm frackers out of the US, frackers out of the Eurozone, because they drill for oil right around $45 to $50 a barrel. Saudi Arabia's around that mid-20s. And so they're like, let's bankrupt everybody, corner market share. Well, what happened was the opposite. It entered bankrupt. Well, it did bankrupt some of the smaller U.S. companies, some of the smaller European companies. But what it also did, Mark, is made Saudi Arabia, basically go into about $100 billion in debt. And it really impacted their pensions, which is a massive conversation in Saudi Arabia. That fundamentally altered Saudi Arabia to the point where they don't want to drive markets. They don't want to drive it down.
They made the
they want to
conscious
secure it up.
Yeah, they consciously make, and you can see this in OPEC notes and some of the other things. I mean, there's a reason I make the joke. The joke is based on history and a strategic pivot that happened after that. And it is not surprising that when they want to stabilize price, they know how to play this game so well.
They're very good at it.
You know, they know the rhetoric, they know how to play the game. And so cut today. Now, crude oil, you never know. Like you get these headlines and crude oil could be down tomorrow. Man, I'm a buyer, and I'm not only a buyer of oil through USO, UCO cash flow means, especially on pattern, but cash flow naked puts. Anyways, I think you have to look at energy companies from a fundamental point of view. Structurally, we're in a supply deficit. There's going to all this talk about recession and demand, blah, blah, blah. Structurally, the supply deficit. These companies are cash rich. We talk about this all the time over the years on the halftime report. They're cash rich. They have paid down debt over the last couple of years. They're about as healthy. Matt, I've been doing this about 15 years. You've been doing this about 17, 18. Energy companies are the most healthy from a fundamental standpoint that I've ever seen in my time doing it.
I wouldn't disagree with that. They got the best valuations and best growth in front of them that they've ever had in my lifetime. And maybe, when we first started, I mean, it was ExxonMobil was the big dog of the world. It wasn't Apple Computers. It wasn't Microsoft. That was after 2010, where they became what they ultimately did become to the market. But it was a game between Apple and like ExxonMobil at that time. And it is at this point the best fundamental and behavioral landscape for oil companies than I've had in my career.
Yeah, and that's with someone who is priced in a recession. Like I think we're having one, right?
So do I.
And so it is like it's tactics, right? It is just an area I feel out of all of the cyclical areas.
People need to understand what a recession means, Mark. A recession doesn't mean the end of economic analysis. It means contracting GDP.
Yeah, and
if Saudi Arabia is going to cut more than the contracting GDP would cut, then price goes up. It's a demand equation.
And make no mistake, just because you have a recession in the United States, it might be a different type of recession. Financial crisis, it was a recession everywhere. The whole globe was shutting down. You got China and other areas. It might be a United States like centric recession. This is obviously going to be felt. You don't have the size of the economy of the United States. It's not going to be felt elsewhere.
I was going to say, you don't have a recession in the U.S. without having it in about 187 other countries.
But you got China pumping at the same time. Could there be some offsetting? I'm just saying I'm not ignoring the fifth B. I'm just not ignoring the fifth B, black gold, particularly from a cash flow perspective. And I am certainly interested in pattern development.
And I think that's where my head's at right there. I mean, you've had a V-shaped recovery over the last week or so in crude oil, energy, and these cyclical areas of the market have done really, really well. I think for me, I think it's on that radar for pattern development, right? And when you're looking at an asset class and you have labeled it, you're waiting for a pattern develop, you're looking for a trade there is what you're doing. And you're saying, okay, what is that next pattern? Do I need to see a retracement? Do I need to see a breakout? Do I need to see a continuation pattern? That's up to the trader to say. What I would suggest is let's see what that next pattern is from a momentum perspective. And there's two momentum patterns that I'm always tracking in times of momentum for bullish or bearish, and that's the bull flag and the high base. Those are the two patterns that I want to see develop on something that's slightly overextended. But I certainly do agree with you from a thematic perspective. You and I have been waiting for Saudi Arabia to come out and say, hey, we got your back, oil. It's a little surprising they do it when it's going up 3, 4, 5 days with a lot of momentum. Usually they come in after a break of support with volatility in the oil market. But it's good to see that the OPEC cronies still have the back of the oil traders.
Sometimes it is sometimes like the 20 weekly has been acting a resistance. Sometimes you need a catalyst to break through key resistance levels. This certainly fits the bill. Anyways, big huge news, right? Big huge news on crude oil today. All right, Matt, let's talk about the dollar. And this is going to be a 3-part series, I have no doubt. And my interest in doing this subject is from a trading consumer point of view, right? Like, I'm a trader, I'm an investor, I absorb information, and I have a lot of news sources, some of them mainstream and many of them not so mainstream, in collecting opinions, information. This I have for
Where's
years.
Zero Hedge? Is Zero Hedge mainstream?
They're actually kind of midstream for
okay,
me, right?
that's about off mainstream as I get a Zero Hedge.
Like, yeah, no, I go a little deeper in the rabbit hole.
I know you do. I can't. I can't pull myself out of the rabbit hole if I start diving a little too deep.
Yeah, I go deep in the rabbit hole. But I have for years and years and years seen news headlines and commentary and thesis on the death of the dollar reserving or losing reserve status on non-mainstream headlines and analysis for years and years. So that's not news to me. In the last week or so, I have started seeing a lot more of that analysis creep up the news line, where you're seeing interviews on Fox News, where you're seeing, Forbes, Bloomberg, addressing it. Now, some of them very pro, the dollar's never going to be beat, raw, right? But it seems like everybody had an article out on it this week with the news of China and Brazil. And it has seemed to be a topic that is starting to circulate up from the bottom feeders of my news feedly program, and I have a lot of questions. Yeah. But in talking to you about this, like, before getting into the ramifications, right? Because that's going to come in part 3, and before getting into current events, that's going to come next week. I want to talk about the history, because you and I have the same belief as far as understanding things, that if you do not understand the history of things, how can you make proper analysis on what is happening today? You shouldn't talk
if you don't understand the historical.
If you don't understand the history of bear markets, don't speak about this.
Don't be a bear.
Don't speak about, listen, Bear. If you didn't know in .com, if you think this is .com, if you didn't know that there were 4 rallies over 20%, that there were 11 or 12 rallies over 10% in .com, then you shouldn't be a bear, right? Like, knowing the history of things helps you become really good in the current, right? And so, understanding the history of currency, which I am not an expert on, and I'm pretty sure not very many people are, I just want to talk about the history of currency a little bit, setting the stage for some of our further discussions, if that makes sense.
It does. And, it's like I was talking to you pre-show. You can take this conversation a lot of different ways. Like truly, I've had all of these conversations. They never start the same. They never end the same. They just go wherever they want to go, because it is a long, long, long conversation with a lot of different, forks in the road you can go down. And so I'll just kind of let you lead the way, and then I'll just respond here. Where do you want to go first?
Well, I don't know if I want to go all the way. I want you to spend a couple minutes on the origination of currency. Not a endless conversation.
I got you.
And then I want that quick. I want a quick journey up into World War II, where the dollar became a reserve currency, right? That's what I would like.
History of currency in 30 seconds. Okay, I gotcha.
Maybe 4 or 5 minutes, right? But
first of all, it takes currency longer. Is just a form of payment for goods and services, whatever that is. The currency has been a lot of different things, but let's talk about what we would consider currency. The first currency that was created is back in around 500 BC is when the first currency was created. It was Greek coins. It was called the drachma. And basically, this currency was utilized as a reserve currency. Now, there were coins before this. There were other forms of payments before this. But after this was the birth of what is known as the reserve system. And what a reserve currency is currency that's held not by the nation state, it's held by other nation states to conduct international trade. And so let's say you were in let's say Egypt in 350 BC, and you wanted to trade your silk for something that the Greeks had, right? Well, you wouldn't trade it in any other currency other than drachma. You would have to both have the Greek coins to conduct that international trade. And so that was kind of the birth of not the modern currency systems, obviously, but the historical currency systems. And that's where the birth of that phase one of the history of currency really kind of starts. Because before that, once again, it's not that you didn't have forms of payment, but it was more bartering, right? Bartering economic services.
Which is inefficient, right?
It is, and it still happens today. I'll give you 3 eggs, you write me a contract, right? Let's have a handshake agreement. They're all over the place. They happen today, they happened before, but that was the primary form of payment, was that type of bartering services. Before this, now you go into a coin. And so the birth of currency really starts in the birth of democracy, and that's ancient Greece. And that's when they utilized Greek coins as the first reserve currency. That obviously didn't last. And that's
all right. I got just one little question on that, because I think it feeds into lots of other. So basically, it's faith and trust in the thing, right? Like the Egypt or whoever it may be, respect of power. What is it that do you think that made
commodity? It's the intrinsic value of commodities.
Like there was worth there. Like,
well, because the Greek coins were made from silver and gold. And so Greek coins were not just made out of nothing. They were made from the physical metals. And so they were silver coins, they were gold coins. They had intrinsic value. And so when you talk about the concept of what was backing that, well, whenever you talk about what's backing that, you're talking about something that only has extrinsic value. And so when you're dealing with the topic of intrinsic versus intrinsic value is tangible. It's real. We can understand it. Extrinsic value is nothing. It's based on nothing. It's a decaying asset of time that will eventually go to worthless. And we talk about that concept of backing a lot in 2023, because we deal with fiat currency systems that are fake money that are based on faith. And if that faith and confidence erodes and there's nothing else backing it, the value of the currency goes to zero. And so when something is faith-based, that's a fiat currency system. But back then, it wasn't faith in the Greeks, in the Greek government, in the Greek military. It was faith. It was the actual tangible value of the raw industrial metal that you could always melt down and reform into your Egyptian coins if you wanted to. And so it was always backed by that industrial metal itself.
All right, fascinating. So what happened from there, right? Like obviously the Greek drachma fell out of favor at some point.
It did. It didn't last too long either. The Greek drachma lasted a few hundred years, and then it went to the Romans, and after the Romans, it went to the Byzantines, and after the Byzantine, it then ends up in you go really kind of into the 7th, 8th century into China. And when you're looking at,
is this because I'm a noob on all this, so I'm going to ask just questions. That
listen, you can ask any question you want.
So is this all silver gold based? The currency itself, like there was an intrinsic value to it still, as a general rule?
No, not at first. Not at first. At first, when it went, and are you talking about Rome, Byzantine?
Yeah, Rome, the other ones that picked up the mantle.
That was all coins. And so I think it was the Aurora's coin out of Rome. This I might be butchering these names.
Yes, I'm sure. Right.
The Solidus
sports announcers have a tough job.
Yes, they do. Yes, they do. But in the 9th century AD, so you start really in the 5th century BC, you work all the way in the first phase of the currency historical conversation to about the 9th century AD, and you find yourself up in China, Mark. And at this point, China introduces the first paper currency. Up until this point, it was just commodities. That's really all it was, right? Greek coins, Roman coins, Byzantine coins, Chinese coins, Coins everywhere. Everybody's got their coin. Everybody would stamp it with their king, stamp it with somebody important, stamp it with the Pope. It doesn't matter. Everybody's got their coins, right? And so up until then, everything's coin denominated. Well, as you start to work into the 9th century AD, China inserts the first paper currency. Now, the first paper currency didn't last very long. It fell, historically it fell, but it fell because when you just have a piece of paper and it doesn't have any commodity backing to it, there's nothing tangible. There's nothing real. It's not even worth the piece of paper it's printed on. You got to back it to something. And this is why you see China having such an importance on copper, even in 2023. Well, what China did is they backed the currency, the paper currency, the first Chinese yuan, the renminbi, they backed it to copper. And that lasted until, guess what? They ran out of copper. And then once they ran out of copper, game over. It's the end of the currency. And that lasted a little bit. But that was kind of the first edition of a commodity-backed currency. It was right there with China in the 9th century with the first edition of the Chinese yuan. And then, and you want this story kind of going into that.
Once again, stupid question. Yeah, would you call it a fiat?
Question.
Would you call it a fiat currency because it was backed by?
No, I won't.
No, because it's not a fiat. It's not the birth of fiat currency.
Paper currency isn't fiat. Fiat is the faith in the paper currency. It's what backs the paper currency. And so
I need to understand why Bitcoin's going to 1 million. Like
it's not. But in terms of the fiat conversation, no, fiat's faith-based currency.
Okay.
And so when you have a commodity backing, you are pegged to a commodity. It's called a pegged currency. Currencies can be pegged to whatever you want to peg it to. If you want to peg a currency to oil, you can do that. You just have to have the oil to back it. If you want to peg it to gold, well, guess what? You need to have the gold to back the currency. You can't just say, hey, we're pegged to dollar. We're going to peg the dollar to gold. But if you want to exchange your dollar, we don't have any gold to give you. Like that's what.
So China ran out of copper.
They ran out of copper.
This is fascinating.
They ran out of copper, and it killed the currency because they didn't have any other copper. Well, it shouldn't be that fascinating to you because that's one of the biggest arguments in the U.S. and why we left the U.S. dollar being tied to gold is because everybody around the world was exchanging their dollars for gold. Whose gold? American gold, which means we were exporting our gold just simply because we were the reserve currency. That was one of the biggest arguments why we left being tied to gold was the unfair nature of us basically getting rid of our supply of gold. And so that's the 9th century, and that's the first pegged currency. It's pegged to copper.
Right.
Every currency from that point up until the 15th century is some degree of commodity. Some degree, and even if paper is injected in the conversation, it's still a commodity. But then in the 16th century, Mark, and again, this is just a historical conversation, and I'm certain I'm giving up some of the dates here. So
of course,
don't hold me too accountable to some of these historical dates. But I'm just doing this off the top of my head.
Dude, this is the TikTok version of the history of currency.
Well, if you wanted the non-TikTok version, it's a 5-hour conversation just up until this point. And so, but then you fast forward a little bit of time, and in that little bit of time, you go into the 16th century, and then you start getting into the European reserve model. And in the 15th, 16th century, you had the first central bank created out of Florence, Italy. And the Florentino, led by the Medici, basically, and this goes back to you and I's political science courses back in the day, Machiavelli and the Prince and all of that. Well, that was through Florence, Italy, and the first creation of the first central bank was out of Florence, Italy. And basically, he who controls the supply of money controls society. That was basically the adage of the bank. And so basically you had that first reserve kind of being created in the process. And then all of a sudden you now start going through this historical moment from the 16th century all the way to the 20th century, that 400-year time frame where the Spanish dollar becomes the #1 reserve currency of the world. Then it goes into the Netherlands with the Dutch gulden becoming the #1 currency of the time. Then it goes to the franc out of France, where that becomes the #1 currency. And all these last for about 80, 90, 100 years, Mark. All of them do. And then eventually by about the 1815, 1820, all of a sudden the British
The
pound.
British pound, yeah.
Number one economy, number one military. They're expansionists. They're injecting their currency throughout the world, into Australia, into the Asian zone, into Africa, and ultimately into the United States as well. That injects itself all throughout the world. And then all of a sudden it becomes the British pound as the number one reserve currency.
So what was so you have this, 5-pack of people taking turns about every century or so.
Every military power out of the Eurozone for about 400 years shared.
So what was it like?
Power.
Was it military strength? Was it? I mean, what was like?
It's a combination of both. Like they go hand in hand. I mean, it's not like you're going to have the number one economy without also probably the number one military as well. And so it kind of. You could make either argument. You could say it's the number one military. You could say it's the number one economy. They kind of go hand in hand. It's he who holds the power. And so whoever is the most powerful it's like, let's say you and I show up at the negotiating table, Mark. Well, if I'm the most powerful, I can insert my will on the negotiation parameters. And that's what trade deals are. They're just two people standing across the table, whether it was 500 years ago or whether it was last week. They're just two people standing across the table negotiating parameters of a trade deal. And what's going to be very, very important in these trade deals is what currency do we use to settle the trade? Well, that's where these reserve currencies become very, very important, is there's no discussion in what currency are you going to settle the trade in, because if there's one common currency that is utilized by everybody in trade, the trade deal said we're going to use the Spanish dollar. Everybody owns the Spanish dollar. We'll just use the Spanish dollar, because that's what you have to do when you're a reserve currency. Is every other government, every other bank has to hold your currency in reserve. That's what it means to conduct that international trade in. And so, yeah, it rotates throughout every economic system. And then what happens is then something typically bad occurs where another power emerges, and then they become that next reserve. And in World War I, Mark.
So the British pound became it in about 1850,
1820, like in that time frame.
Yeah, because there isn't a moment, right? Is there?
It's not.
Because there's not like, hey, on April 14th, 1632,
you can
the
go
Dutch lost control of the reserve. No,
you can go to when a trade deal is signed to pick the date of when it occurs, but it's not a singular moment in time, because usually what occurs before that trade deal is ever even signed is it's already overtaking from a reserve perspective. And if you'll understand what I'm talking about when we get through up until 1944. And so in World War I, in 1914 to 1918, the only country that is part of the reserve conversation that was not impacted economically to utter destruction was America. Remember, it was us in 1917, 3 years into the war, that finally joined the war, right, in 1917. And then when we joined the war in 1917, we were already quickly becoming the number one exporter, the number one industrial power. We were also becoming a reserve currency. We were already overtaking the British pound. But what was really occurring is by 1918, the British pound had been decimated because of World War I. And when everybody owns your currency and the value gets just absolutely pummeled and you're down 50%, well, all your holdings are down and you don't want to hold that currency anymore because you want a safety. People want safety as reserve. They do not want Bitcoin as reserve, because what does Bitcoin do? Bitcoin will go from 10K to 50K back to 20K. These old dogs at the central banks, they don't want to deal with that.
No, nobody wants to deal with that on that level.
Yeah, they don't want to deal with that. And so you got to have some stability to be a reserve. You got to be offering a very, very liquid bond market that isn't going to implode. And so all of a sudden by 1918, the United States, quickly emerging as the number one economy in the world. We're already the number one industrial power in the world at that point. We're quickly becoming the number one exporter at that point. But more than anything, we weren't located in Europe. That was decimated by World War I. I mean, Mark, we're talking about some of the most important 4 years in the history of the entire world is World War I, sets the stage for World War II, and utterly decimates the entire economic landscape around the entire Eurozone. I mean, if it wasn't for the economic annihilation of the Eurozone between 1918 and really kind of 1932, there's no Stalin, there's no Mao in China, there's no Mussolini in Italy, there's no Hitler in Germany, because the only way these individuals of authoritarian just power come to take reign of the German chancellorship in 1932, for example, is only through massive economic pain, massive economic pain. That's happening across the entire Eurozone. Well, who's not dealing with that? America. They're not dealing with that. And so in 1944, there's a Bretton Woods Agreement that is signed between 187 other countries out there to officially replace the United States dollar as reserve currency.
Dumb question number 40.
So really quickly though, before you get to that one. So why am I fast forward to 1944 when we're talking about 1918 and the 1920s? Because it wasn't in 1944 that the dollar actually became a reserve currency. It was in 1918. It was in 1920s. They don't happen in a singular moment in time. It's over time. This bank, this corporation, this government, they adopt a dollar instead of a pound. And then all of a sudden, by 1944, when the writing's already on the wall, when everybody already owns dollars, when the United States is obviously the #1 superpower to everybody around the world, everybody just kind of ties the ribbon on the bow on the trade agreement called the Bretton Woods Agreement, when the reality was this was already occurring. So when you go back to your other question, I know this was a long-winded way of
it's been fascinating.
But when you go back to the starting point of a reserve currency, there's not really a starting point to it, because it's done over time in conjunction between one superpower historically leaving their supremacy and another one, and the birth of another superpower overtaking that.
All right, my next dumb question. Was this the first time in history that you had, in Bretton Woods in 1944, that you had countries sit down and formalize through an agreement?
Well, it wasn't the first time, no, but it was the first time we had to that degree.
To that degree,
yeah,
where you have this basically 100 and what, 180?
It was 187. It was these trade agreements historically, Mark, were more like with the European Union, not the European Union, but
so you've had lots of
Europe.
Minor ones, but nothing on this scale.
They were more regional. They weren't global. Yeah. They were more regional. Even though the pound, the franc, the Spanish dollar, the Netherlands dollar, even though all of those were historically international reserve currencies, the bulk of that international reserve was in Europe. The bulk of that was settled between partners that were relatively close together. By 1944, the world had tied itself so close together economically that, yes, this was the largest scale deal that did settle in a currency. And what's important about this deal at Bretton Woods is that it basically officially named the dollar as the reserve currency of the world, but it also tied it to gold at $35 an ounce. And once again, even though this was settled in 1944, all of these were done in the 1920s and 1930s as the U.S. was trying to own all the gold, which is a fascinating story in and of itself, how they acquired said all gold to back the dollar by gold. But it did officially create the gold standard in 1944.
The gold standard. All right. So what, I mean, so obviously some things happened in the 70s. I know my history well enough to that. Anything really exciting happened between 1944 and 1970-ish when we went off the gold standard?
Lots of things called the Cold War. Remember, the history of currency is told very, very closely with the history of conflict around the world. And so many things happened in the 1950s, 60s, and 70s. But really the date we need to talk about, and this is the natural stopping point in the conversation, Chucky, is 1969. 1969, one of my favorite songs by Bryan Adams, by the way. 1969 was a very important year even though it happened before 1971. 1971 is when we officially removed the gold standard from the equation. But like these don't happen in a singular moment in time, Mark. There was a lot of chatter for about 10 years that we were going to leave the gold standard because of some of the difficulties of being a gold standard is. Remember, if you back your currency to a commodity, what can anybody do? They can exchange their currency for your commodity. Well, what would you rather have, U.S. gold or U.S. dollars if you're international? And so it creates a little bit of an unfair. There are massive advantages to being a reserve currency. I'm just pointing out one flaw in being a reserve currency as pegged to gold is you have to own the gold. And then if you wanted to go get gold, you could just go to a bank and just exchange $35 to get 1 ounce of gold. But it's a natural stopping point because of what occurred in 1969. Everybody talks about 1971, but what I feel is important is 1969 and what the IMF did for the first time in the IMF history. The IMF, the International Monetary Fund, was created in 1944 too. The World Bank was, the IMF was, all these governmental international organizations that basically were created to stave off World War III, right? They were all part of the same type of international plan there. Well, the IMF doesn't have a currency. The IMF uses other currencies up until 1969. And in 1969, the IMF created a basket of a currency, kind of like a bond it acted as, called the SDR, otherwise known as special drawing rights. Now, the SDR doesn't have value in and of itself because the SDR more acts like a bond that the IMF uses to shift money throughout the world. And so if you're Australia and you want to get access to reserve dollars, well, you usually don't go to the United States for that. You usually go to the World Bank. You go to the IMF for that. When the IMF inserts their economic power into an impoverished country, for example, or a country that is hit by famine, or a country that's hit by war, or whatever the case might be, for example, Ukraine. When the IMF comes in to help Ukraine, they don't do it with dollars. They actually now do it with SDR. And so the SDR is created. The SDR was created, in my estimation, as a direct competitor ultimately to the United States dollar. I'll get into that conversation a little bit next week as we talk about the end of the gold-backed dollar, the creation of the petrodollar, and the creation of the SDR. And that will bring us up until about 2009, Mark. And then in our third edition of this currency conversation we're having, we're going to talk about the modern currency environment and what is occurring right now that's going to impact all of us down the road, and what can we do about it to make sure that we're protected, number one, and thriving, number two, in that environment. Because, and I'll just say this, Chucky, whenever we have these conversations of currency and history of currency, reserve systems, they can spark a little bit of fear. And I'm gonna
absolutely.
I'm gonna give it to you. I'm gonna give it to you raw over the next 2 weeks, guys. I am. I'm gonna give you the information, but I'm also going to tell you that I don't fear these conversations in any capacity. And it's not because they're not scary. They are scary. They are, and they do cause fear. It's just that in every single moment of history, when these things have occurred, yes, money shifts hands, money is lost and money is made. But you can always, if you have knowledge and you utilize that knowledge, you have a terrific asset class. And so it's with the knowledge that you can do things. With knowledge, why should you diversify from the dollar? Well, it's because of this conversation why you should diversify from the dollar. Well, what should you diversify into? Well, it's gold, it's Bitcoin, it's digital assets, it's stock, it's anything besides dollars. And so when we're having this conversation, don't allow it to spark fear. Allow it to spark momentum. Allow it to spark desire, allow it to spark a burning sensation within your soul that you will acquire whatever you need to acquire to help your family, to help your community, to help the people that you care about, because it is with knowledge that we can do whatever we need to do. Warren Buffett said it better than I can. He said, knowledge is the new currency. with knowledge, and I'm going to bastardize the quote, but he basically said, knowledge is the new money. There can be all things happen: inflation, economic recession, government outspending everything, you name it. All things can happen out there. Anything and under the sun can happen. Good, bad, ugly, it can all happen. But if you have knowledge and you will execute that knowledge, meaning you just don't sit and bitch about it to a buddy, but you actually use that knowledge to build something, to do something, to create something, to do something beneficial to yourself, your family, your community, the people you care about, then you have a terrific asset. That's what this conversation is about. It is not, because I'll tell you right now, Mark, I've heard a lot of stuff in the last 5, 6, 7 days on this topic that burns my ears about how it's just fear mongering. Because this conversation can be used to fear monger very, very, very easily. Please don't allow it to be that, because that is not my intention behind the topic. And
no, knowledge reduces volatility.
That we have over the next couple of weeks. I'm just going to give you my honest take based on my honest research. And let the cards fall where they be. But it is my estimation that we are in the process of not losing reserve status. The dollar will never lose reserve status, Mark. The dollar's not going away in your lifetime. That is not something you have to fear. The dollar's not going to go to zero. What you're going through is a reduction in the percentage of how it will be utilized in the future. And if you just want to anchor to a few stats out there, in 1971, when we were a gold-backed standard, international trade agreements, 85% of all trade agreements was settled in US dollars. By 1999, that had been reduced to 70%. By 2009, that had been reduced to 65%. Right now, we're at 59%, Mark. And so in the last 50 years, we went from 85% to 59%. Mark, we're going down to mid-40s. That's what we're doing. The international trading community has spoken. They want to go to a diverse currency system. No, they do not want to kill the dollar. China doesn't want to kill the dollar. I do not believe that. Are you kidding me? China owns a tremendous amount of US dollars. They don't want to kill the dollar. They want a fair landscape to compete in. They want to be part of the SDR. They want to be part of a diverse currency system, because when you look at the 2,000 years of reserve history, it's always been one singular currency that was dominant. Well, they want to move to a less dominated currency system internationally. Think about it like a stock trader, Mark. Would you rather buy one stock or would you rather buy an ETF? And if you buy one stock, you deal with a little bit or more volatility, though, than you deal with
absolutely,
ETF,
100%.
Right? Well, that's what the international
one
trading
stock. I
community is
have to
talking
be
about.
right. I have to be right on one stock.
But if you have 7, you don't.
And then I got some room for it.
Right. And that's where the SDR comes into play here. It's known as special drawing rights. We'll talk about this in detail next week and the week after. But it's a basket of currency. Remember, currencies are backed by faith in 2023 at this point. They might not be backed by faith in the future, because that faith is wearing very, very, very thin. When you look at the basket of the SDR, it's a basket of weighted currencies. And it's a weighted currency with the dollar still being the number one currency. My analysis, my research leads to one conclusion. The dollar continues to reign supreme. It just doesn't reign supreme to the certain extent that it has for the last 80, 90 years. It will never be 90% utilized around the world again. It will never be that. And I'm not even sure it was designed that way in the beginning to be utilized like that. But it will reduce its importance over the course of the next 20 years. And it is my belief, based on my understanding of this topic, that we're going to lose about another 15% in utilization, which would be similar to what we've went through from basically 2000 until today.
Fascinating stuff. Seriously, fascinating stuff. I look forward to these conversations, Matt. Listen,
next week, 1969, 1971. We're going to talk about the gold standard a lot next week. We're going to paint that picture in the currency conversation up until 2009 next week.
Good deal. Good deal. Well, let's send this out. Listen, Matt, upcoming events. We have the unemployment report on Friday, but the market is closed.
I
That one.
don't know what they're doing on that
Like
one.
seriously, like, and so like as far as
Fix
events
it,
in
guys.
the trading week, we got a few minor reports, but not a lot going on. The market's going to have to digest unemployment and CPI report in the first week. I can't remember that ever happening before, but that's next week. This week, a little light week, but it's you know, technicals this week, isn't it?
Yeah, it is. We're still in a technical pocket here, and it's been very, very, very nice actually to be in that technical pocket. So, not a lot of major news coming out this week. You do get the labor market on Friday, but the market is closed. You get some manufacturing data before that, but it's another technical week out there. And if you like the podcast, guys, best way to support the podcast is give us a nice little 5-star review on iTunes. And once again, we really, really, really appreciate all the comments on the podcast, all the iTunes reviews. We love you guys, and we hope you really enjoy the podcast. Hope you enjoyed the podcast here today. If you are not a member of Tackle Trading, I highly suggest you go over there to tackletrading.com, sign up for a 15-day free trial, and in doing so, you get a lot of goodies, including everything we do for our pro members, the 10 to 15 webinars every single week, reports everywhere on the stocks, options market, commodity market, the Tackle Trading newsletter, but you also get access to the Option Success class, which is a class Coach Gino Pora and myself teach. We're teaching one this Monday and Tuesday. By the time you listen to this podcast, we'll probably be done with that Monday edition. But we'll have one coming up in the third week of April as well. So it's a great time to become a pro member of Tackle Trading, because pro members get access to that amazing 6-hour course, 2-day live training with some of the best on demand you'll ever get from an educational perspective. Definitely check that out. So that's the Option Success class. You get it with being a pro member of Tackle Trading, and you can get a 15-day free trial, which means you can get access to some of the best education in the entire space with nothing but a 15-day free trial. Check it out, guys. You won't regret it.
Yeah, we appreciate y'all. We'll catch you next week. Listen, I love what Matt said. If you want to show your appreciation for the podcast, just go give us a good review, thumbs up, all that stuff that I have no idea how to do. But
do it.
With more other people, do it. Have a great week, everyone.
Later, everybody.